Hello, everyone. Welcome back to the Weekend Charts. This is a special edition of the Weekend Charts, which I'm calling the State of the Markets, June 2024. I'm going to try this every couple of months, take a look at all different asset classes, tell you very quickly what's going on, and break it down, of course, with a lot of charts. This is what I'm going to be discussing today. We have stocks, bonds, the Fed, real estate, housing, commodities, currencies, crypto, some intermarket analysis, and we'll end with the U.S. economy. So a lot to go through, and let's begin with the stock market. And pretty good start to the year for the S&P 500. We've already hit 24 all-time highs in 2024, and we're only in early June here, so we're likely to see more all-time highs to come. And if we look at what's driving that, the major driving is the story around earnings. I would say that we have another record high in terms of earnings. We're almost through Q1. 98% of companies have reported. And if we look at operating earnings per share for the S&P 500, they are hitting another record high over the last 12 months, driven in large part by the large cap US stock market and companies like NVIDIA and the other big tech companies doing very well once again in the first quarter. If we look at the US versus the world, this is a long trend of US outperformance. And so far, year to date, US stocks continue to outperform. So up and to the right in terms of that outperformance. And I would say this is the longest period of US outperformance in terms of US versus the world that we've seen on record. And here we are in June 2024, and doesn't appear to be over just yet. If we look at US versus emerging markets, similar chart here, but more pronounced, bigger outperformance versus emerging markets over the last decade. And so that strength also has continued year to date. Within the US market, looking here at US large caps versus small caps, a long trend of US outperformance here. We had that brief period of small cap, huge mean reverting move higher, but that has been erased, and then some with the relative strength of large caps hitting a new high here. And if we flip it and look at the other way around, look at the ratio of small caps to large caps, what we're seeing here is the lowest relative strength for small caps since November 2000. So you can see all of that outperformance that we saw past 2000, past the bursting of a dot-com bubble where small stocks and value stocks had outperformed, all of that has been erased. And now we're back to November 2000 levels in terms of relative strength. And if we look at what's driving this, there's a number of themes. Obviously, growth, tech, big cap tech really driving this outperformance. And it's really become really pronounced this year. If we look at the top 3 stocks in the S&P 500, they now make up almost 20% of the index. That's by far the highest percentage we've seen on record. We have data going back to 1980. Which are those 3 stocks? Well, now Microsoft, number 1. NVIDIA is actually now the second largest holding in the S&P 500, actually passing Apple this week, and Apple being number 3. So big concentration at the top, and that's happening because the biggest names continue to outperform. NVIDIA obviously moving way up over the past 2 years in terms of its percentage of the S&P 500. Let's take a look now at growth versus value. And we have huge outperformance, of course, in 2020, just enormous mania in terms of growth stocks, anything tech related, huge advance. And from there, it's kind of been a sideways market. We saw value really outperform in 2022. But last year, 2023, growth resumed the uptrend. And this year so far, growth is outperforming once again. So if we look at it compared to, let's say, the last 3 years, it's kind of sideways. Last decade, obviously, growth, huge outperformance versus value. And the question is this hitting a point where we're going to start to see a reversal in the other direction? People have been making that argument for a long time, and we'll have to wait and see. But certainly, seems to be the case that value stocks are more compelling on a valuation basis than growth stocks. But you have the NVIDIA factor, you have the AI factor still driving the narrative higher. So looking at tech versus the broad market, not exactly the same as growth versus value. Sometimes technology is a big representative of growth, sometimes not. So a little bit different here. But what we're seeing, something interesting here, is that year to date, tech is actually kind of in line to slightly underperforming a market. So even though we're seeing that growth move higher, even though we're seeing that huge advance in terms of the semiconductor space, we're not seeing it necessarily in broad technology, that outperformance. So interesting thing to note there. But if we talk about semiconductors, that has been the story over the past year. You can see just the huge relative outperformance of the semiconductors versus the S&P 500. Of course, driven in large part by NVIDIA, but not just NVIDIA, another number of other names within the semiconductor space also outperforming. So this is just an enormous trend here, and it had been going on prior to the past year, but the acceleration in the past year is something we haven't seen in a long time. You have to really go back to 2000 to see the relative strength of the semiconductor space versus the broad market at these levels. And if we look at NVIDIA here, obviously driving that semiconductor space higher. Now, as I mentioned, the number 2 stock in the S&P 500, kind of incredible. Now over a 6% weighting in the S&P 500. So if you're an index holder, you hold a total U.S. stock market fund or total world fund, NVIDIA is becoming a bigger part of your portfolio. You are participating in that already. If we look at where NVIDIA was just a few years ago, it was about a 1% weighting in the S&P 500, now all the way up to over 6%. This is kind of interesting here because a lot of people might consider what's been going on lately, momentum driven market. But if we look at a momentum factor, which is simply kind of quantifying which stocks have outperformed and buying those stocks and then rebalancing periodically, this is the momentum stock ETF versus the S&P 500. You could see 2020 was a great year for momentum, but since then it's been very difficult. And the reason for that is we've seen alternating kind of leadership, where we had leadership in 2022 in terms of energy, and where you had the bear market in US stocks and tech really underperformed. Then last year it flipped, energy underperformed, tech outperformed. So you're seeing that reversal again. So very difficult to be a momentum investor, it seems like, over the past few years. I want to take a look here at high beta versus low volatility. And what we saw in 2020 was a huge surge. Well, initially, huge move lower in high beta, of course, during the COVID crash, and then a recovery where we saw this really speculative frenzy into high beta stocks, high volatility stocks. But since then, kind of sideways in terms of they underperformed in 2022, outperformed last year, and this year kind of sideways with the broad market. So no big theme in terms of high beta or low volatility this year. If we're looking at discretionary versus staples, I often look at this as kind of a sign whether the U.S. consumer is increasing their spending or decreasing. Are they showing strength, or are they showing weakness here? And I've been talking a lot about the consumer potentially pulling back, and I think this is yet another sign of perhaps that's occurring, where we're seeing discretionary stocks underperform staples this year. So discretionary stocks would be not your food and beverages, things that you need to buy, not your grocery items, but other things like electronics and things like autos. That's a discretionary product. And those things have been moving lower. And part of that, of course, is driven by higher interest rates. The other part is simply that we had a huge run up in terms of discretionary stocks following the 3 rounds of stimulus in 2020 and 2021. So you had a huge surge in terms of consumer spending in discretionary areas of the economy. Then 2022, with that high inflation, we saw really a pullback in the U.S. consumer in terms of making these purchases. Recovery last year, but this year again, we're seeing us move lower. So something definitely to watch, I think. And in terms of the banking sector here, very different in terms of looking at regional banks versus looking at the broad market. So of course, S&P 500 hitting all-time highs, up about 12% year-to-date total return. If we look at the regional banking sector here, relative lows here. This is the trend over the last 10 years. But you can see here, this was the difficulty last year when you had the bank failures, Silicon Valley Bank and First Republic. But since then, kind of sideways. So it hasn't really recovered on a relative basis. And still those issues are out there in terms of fears about the office market, fears about their portfolios in terms of holding these longer duration assets. and what that's going to do to this sector. So interesting to see that regional banks have still not recovered kind of on a relative basis, and we'll continue to watch that closely if this spills over into the broader market. But so far, it seems like the broader market doesn't seem to care. We had those failures. The Fed stepped in. They extended the FDIC insurance, and then we've kind of moved on. But still, these stocks, this sector, has not really recovered. Okay, I want to switch gears, talk about bonds here. We look at a number of different relationships in the bond market. First, I want to talk about the relationship between TIPS, so inflation protected securities, and treasuries. And when this ratio is rising, what it means is that investors' inflation expectations are rising. And when it's falling, it's the opposite. Inflation expectations are falling. So you can see here falling, really collapse in inflation expectations in March 2020. People were fearing deflation, fearing depression. But since then, you could see that huge surge higher into 2022 when inflation peaked at around 9%. And now we've gone essentially over the past 2 years sideways in terms of this relationship, but not moving back down. So interesting that inflation expectations have come up and come up significantly since 2020, but are not moving back down here or higher actually year to date. And if we watch this relationship and it, let's say, breaks out to the upside, I think that would be an indication to say inflation is becoming a real problem. Again, for now, it's kind of just treading water, going sideways. Let's take a look at high yield versus treasuries. This has been a big theme in terms of credit spreads have been tightening. So when high yield bonds are outperforming treasuries of a similar duration, so high yield bonds have around a duration of around 5 years, when they're outperforming this intermediate term treasury ETF, that means that investors are taking more risk. Credit spreads are coming down. They don't need to be compensated as much to buy those riskier high yield bonds versus risk-free treasuries. And you can see here, trend over the last year is higher, and really there hasn't been a big scare in the high yield market since 2020. Even when we had that 2022 bear market, we were kind of saying this is a strange thing because credit spreads are not widening very much at all. And typically what you see during a recession is a much bigger widening in spreads. And now with hindsight, we know there was no recession. Perhaps the smart money was right there in saying, we're not going to assign a higher default rate just yet on high yield bonds. But if we fast forward to today, credit spreads very tight. Investor demand for these securities has really surged higher once again, and we're not seeing any real signs of weakness thus far where investors seem to be pricing in any chance of a recession. Look at leverage loans, similar theme here. So leverage loan ETF versus a short-term treasury ETF. You can see big outperformance over the past year. Trend is up, not showing any sign of weakness. If we look at investment grade bonds versus treasuries, this once again saying investment grade spreads have been tightening. I talked about last week, we're seeing the tightest levels in a few years. Jamie Dimon pointed this out, saying essentially that this was going to be viewed in hindsight as a poor bet to make, essentially betting on investment grade bonds with spreads this tight. So you're not really being compensated very much at all for taking risk above the treasury market in investment grade bonds. But in terms of the relationship here, the bulls would say, "Oh, this is bullish as long as this continues to trend higher," because investors are not fearing higher default risk in these types of securities. If we look at long duration versus short duration, this has been a killer for anyone who has long duration in their portfolio. This is comparing the TLT 20 plus treasury ETF to the very short term treasury ETF, the SHV. And what you can see here is 2019 and early 2020, when interest rates were collapsing, hitting record lows. It was great to be a long duration investors. There, you were seeing huge outperformance in this TLT vehicle versus just buying SHV. Cash was essentially yielding nothing. But since then, duration has been a real problem. The reason for that, of course, is interest rates went from historic record lows to about 400 basis points higher for looking at the 10-year. 10-year bottomed at around 30 basis points back in 2020. It is now around 4.4%. So over 400 basis points higher. And that has crushed this vehicle relative to shorter duration instruments like cash. And especially since the Fed started hiking interest rates in early 2022, we've seen just big outperformance where people are now being paid on their cash, but they're still losing money on this 20 plus treasury ETF, at least this year, underperforming once again. If we look at that TLT, we look at the bond market. This is looking at the broad bond market aggregate index from Bloomberg. We're now in the by far the longest bear market in history, 46 months in duration. And so we're still a ways away from the highs in this, from the peak into August 2020. So it's going to continue at least for a few more months unless we see an absolute collapse in interest rates. But this gives you some perspective here. Before this point, this data goes back to 1976, the longest bond bear market was 16 months in terms of you had to draw down, and within 16 months, you were back at all-time highs. Now we're 46 months and likely to be a few more months before we get there. So very different story between the bond market and the stock market. Stock market hitting new highs earlier this year, but the bond market remains in a drawdown, its longest in history. Let's take a look at the yield curve here. It's really been just an ongoing inversion for the past few years here. If we look at the 10-year rate, 441, 2-year 482, so still have that longer term treasury yield below the shorter term yield, which is not a typical situation. You typically see more demand for yield at the longer end. If you're going to lock your money up for 10 years, you often want to be compensated more than for 2 years, but not the situation here. And the reason why this is persistent, well, it's persisting because investors are expecting the Fed to come in and cut rates at some point within the next few years. And so investors are going out in the curve to buy that 10-year or 30-year bond. Now, we'll see. These expectations continue to be pushed back. The yield curve continues to be inverted. But at some point, of course, the Fed is likely to cut rates. And this situation will probably very quickly be rectified with the yield curve having a positive slope again. If we look at the 10-year versus the 3 months, it's even crazier in terms of the differential here. It's over 1% higher if you're getting in a 3-month treasury bill versus the 10-year treasury bond. And this has persisted for 589 days, this inversion. So this negative rate differential between the 10-year and 3-month. That's by far now the longest in history of data going back to the 1960s. So the question remains, is this a signal of economic weakness to come? And as I've said before, the average lag time between that first inversion and when the recession starts has been around 24 months. So we're still not 2 years from this first inversion, which occurred in October 2022. So way too early to say this is broken or this is not working anymore. But clearly, if you're an investor, you don't want to be trading off of the yield curve because the variability in terms of when the economy goes into recession and when the stock market reacts to this type of data is so variable that it makes it useless from a timing standpoint. But I don't think we could say just yet that it's not signaling perhaps at some point in the next year or two that we're going to see economic weakness. Still too early to say whether that's going to happen or not. If we look at the Fed and what a difference this has been this year from where we started the year. So enter the year, we had huge dovish expectations, and the Fed really wasn't forecasting this. They were calling for, I think, 3 cuts in their projections, but the market was saying, no, the Fed is going to be much more aggressive in cutting interest rates. And the market was saying 6 to 7 rate cuts entering the year. Well, fast forward to today, and the shift in terms of market pricing has been enormous. Part of that has been the Fed talking down rate cuts, so they're not going to cut rates when they meet this month in June. And now investors are expecting the first cut is not going to happen until September, and perhaps we get only 1 to 2 rate cuts this year. So big shift in terms of expectations. And the fascinating thing is this hasn't hurt the stock market whatsoever. So a lot of people were saying that if the market wasn't going to get these 6 to 7 rate cuts, that the stock market would have reacted poorly to that. Absolutely hasn't happened, at least so far. And as we stand today, market saying only 1 to 2 rate cuts, and that's assuming, I think, that the inflation data improves from here. If it doesn't, perhaps we could end the year with maybe only one cut or maybe even no cuts. All of that will be dependent on the CPI data to come. So let's take a look at where the Fed is in terms of its policy rate versus what it likes to look at in terms of the inflation rate. And that's the core PCE rate of inflation. That's excluding food and energy. That's what the Fed says is their preferred measure of inflation. And if we look at that preferred measure, it's down to 2.75%, lowest we've seen in a few years, but not close enough, I think, to their 2% target for the Fed to say, we're going to cut today. I think they wanted to see even further progress towards that 2% target rate before they begin the cuts. And if we look at this differential here, you could see monetary policy has only really been tight for about a year now, for looking at a relationship between the Fed funds rate and that core PCE inflation rate. It's only been higher than that inflation rate for about a little over a year. So perhaps we need more time in terms of this restrictive policy to really bring inflation down. I think the Fed for now is kind of on board with that. And they're saying even if we cut rates, it's not going to be a very quick move lower. We're going to do a kind of a measured way lower to make sure that this inflation rate comes down. So this is the tightest monetary policy we've seen since September 2007. So it's been a big shift for market participants because for a long time previous to this, over the last decade, for the most part, with the exception of a brief period here in 2018, 2019, we had a very easy Fed in terms of keeping that Fed funds rate much lower than the rate of inflation. And this is kind of flipping here, and the Fed saying we're going to be higher for longer. And there's good reason for that. And we'll talk about it later in the economic section. And the reason is, of course, we've seen the highest spike in inflation since the early 1980s and the most persistently high inflation that we've seen in decades. So the Fed is reacting to that and saying they're going to stay higher for longer. And I would say, as a market participant, you actually want to see the Fed to stay higher for longer. You don't want to see them having to cut rates aggressively from here, because if you see the Fed forced to, let's say, cut rates to 3 or 2% in the next year, that would mean there's something very bad going on in the economy. And I don't think that would be very good for risk assets whatsoever. So number 3, real estate housing market. This is kind of fascinating because while the S&P 500 is hitting record highs, typically have a pretty strong correlation in the past between S&P 500 and the real estate sector. Not this time around. You're seeing a pretty big divergence here, something we don't often see, where the real estate sector is still down over 20% from its previous high, still in a bear market. So both of them peaked here in early 2022, but the S&P 500 has more than recovered. So it hit its first all-time high in a few years earlier this year, and now it's hit 24 more. Real estate sector still down. Big drivers of that, of course, being number one, interest rates and causing pressure on the sector. Obviously, part of that real estate sector is the office segment of that market, which has really been hit. So it includes a lot of different areas, but we're seeing commercial real estate really be hit much harder than residential, as I'll talk about in a bit. And looking at a relationship between the real estate ETF, the VNQ, versus the S&P 500, you could see here kind of peaked when the Fed, just before the Fed started hiking interest rates, this relationship, and since then has trended lower, sideways over the last 2 years, but kind of trending lower from where it was. And previous to that, interestingly, we were seeing outperformance in terms of the real estate sector. We had a crash, obviously, in 2020, but it came right back. It was actually outperforming the broad market until early 2022. So if we look at the U.S. housing market, very different situation than what we're seeing in real estate investment trust and looking at commercial real estate. So different market, different trends here, and a lot of it comes down to just supply and demand. And the equation, the supply demand equation, still hasn't shifted enough to cause prices in the residential housing market to come down. So what we're seeing here is a chart of U.S. home prices nationally, the Case-Shiller index, hitting once again record highs in the most recent reading. And the red line here is the housing affordability index. You could see pretty close to its lowest levels on record. And what's driving that is two main factors. Number one would be this huge surge in home prices since the beginning of 2020. You're talking about over 40% increase in a few years, and prices are still hitting record highs. And number two, of course, would be that mortgage rate, which went from under 3% to now over 7%. And the gains in the housing market, pretty broad based. This is the 20 city index. And you can see here the last 5 years, we're talking about close to 70% increase in San Diego. We're talking about Miami, 80% increase. Phoenix, 73% increase. Tampa, Florida, 77% increase. And even the lower increases are 36% or 33%. And so everything has gone up the past 5 years with that increase in the money supply, with that increase in inflation. Housing, of course, inflation sensitive asset, because it costs more to build a house today than a few years ago. Obviously, people's incomes are higher. The dollar is worth less. So home prices have readjusted to that reality. The problem is people's incomes haven't gone up as much as home prices, and that's causing this real crisis in terms of affordability. And this is my favorite chart that illustrates that. Looking at the percentage of your income you would need to afford the median priced home for sale. And this is including P&I, taxes, insurance, PMI, but not things like repairs and maintenance. So if you include all that, it's going to be probably well over 50%, but even above 40% here, very stretched in terms of if you're a new buyer and you're coming in right now into the housing market, you're going to have to spend a very high percentage of your income in order to afford that home. And that's why we've seen just an absolute crushing effect in terms of demand. And so if we compare this back to the peak of the last housing bubble in 2006, you can see we're right about that level today. Last year, we hit the highest levels on record at 45%, come down a little bit because mortgage rates are lower today. We were about 8% in terms of the 30-year mortgage. Now we're at 7%, but still very elevated. And the challenge here is that the increase in that monthly payment, which is what most people are looking at until order to afford that home. Most people are not coming in and buying a house with cash; they're financing it. So this payment is everything. And if this payment, if we look a few years ago in 2021, you're talking about around 16 to 1700 in terms of that monthly payment. Today we're at 2800. If we looked at 2020, it would be even lower. I think around 1500. So almost doubling in terms of that payment in just a few years. And of course, people's incomes, needless to say, haven't doubled over that period of time. Okay, one bright spot here that I'm noticing of late in terms of the housing market we're talking about for a long time. When is the supply going to come back to the housing market? Because there's simply record lows in terms of supply, and that's causing prices to go up. There's a lack of choice, which is not good for buyers. And finally, if you look at this blue line here, we're seeing an increase in terms of inventory. So sellers seem to be coming off the sidelines. Perhaps they were waiting for interest rates to come back down, and now they can't wait anymore, don't want to wait anymore. But regardless of the reason here, we're seeing this trending higher versus last year, 15% increase in the number of listings for sale. So watching this very closely to see if this continues, we get this back up to a normal level. That will be very good for a normal housing market, and very good, obviously, for pricing. If you're a new buyer, the biggest factor is that price. And for prices to come down, you need more inventory in the market. Now let's talk about the rental market, which has been a very different story than the housing market. Initially, it looked the same. You had that spike in terms of prices for rent during 2021, same as home prices. But since then, and really since 2022, we've seen a big divergence where U.S. home prices have continued to hit record highs, but rents have kind of gone sideways. They peaked in 2022 when inflation peaked and have gone sideways over the last 2 years. And at the same time, people's incomes are still going up over the last 2 years at about 4 to 5% per year. So much more affordable in terms of renting versus buying. And a big reason for that is simply inventories are much higher. If you look at apartments, there was huge boom in construction over the past few years, and now that's leading to more vacancies and less pressure, upward pressure in terms of pricing. Landlords, if they have a higher vacancy, they're not going to charge as much. So the renter, it's really a renter's market rather than a buyer's market. And if we look at the past year here, you're seeing the asking rents actually down 0.8%. So whereas home prices are still running up 5, 6, 7% on a year-over-year basis, depending on the location, what we're seeing for rents is a decline over the past year. And now that's 12 straight months where we've seen a year-over-year decline. And so this is the chart to look at if you're considering buying versus renting right now. And buying would be a stretch for you, where you'd be in that situation where you're spending 40, 50% of your income in order to buy a home, something not really advisable because it's going to leave no money for anything else, no money for emergency savings or investing. Well, the good news is that renting a home has never been better relative to buying a home. So this is the premier discount of a U.S. home versus buying versus renting, and you have to pay 52% more in terms of buying a similar house versus renting something similar. So that's a record high, and as long as that persists, for a lot of people, they're choosing obviously renting because they can't even get the mortgage even if they wanted to buy. But certainly from a financial situation, it would put them in a very, very bad place. So this will change. I don't think this will stay at this level forever. You're going to see more supply. Things will even out. More supply in the housing market might take a decade for this to change, but clearly this is not sustainable to stay at these levels. Obviously, what would change this as well is if mortgage rates were to come back down to, let's say, 4 or 5%, that would certainly help things as well. But for now, it's a renter's market, and it seems like that's going to continue. Number 4, let's talk about commodities briefly here. If we look at the broad commodity index, you can see since its inception, which it started at around 2006, you can see it's essentially gone nowhere. So commodities have not been a very good investment over the last 20 years. You've had brief periods of very strong performance. Certainly in 2008, when oil hit a record high, commodities were all the rage. People love them. And then from there, they would crash in the back half of 2008. And really, over the past decade, commodities have definitely underperformed almost everything else. And if we look at the period in 2020, that would mark the low. If you remember, crude oil futures for a brief moment in time actually went negative, and that would be the low in the commodities market. We saw a huge surge from there. And after Russia invaded Ukraine, you had oil prices and other commodities spiking higher, with oil and gas prices actually hitting a record high, over $5 a gallon in the US. But since then, prices have come back down in terms of crude oil and gasoline, and we're kind of gone range bound. So if we're looking at commodities over the past year, this is something I often look at as kind of a read into CPI. Into overall CPI, which tends to be much more variable because of this component here from commodities. That energy sector, very, very volatile. And what I'm seeing here, things like cocoa, you can kind of throw out because not a huge part of the commodity index. But if we're looking at industrial metals, if we're looking at zinc and copper, aluminum, those are starting to perk up here. We talked about copper hitting a record high a month ago. It's kind of pulled back from there. The other notable thing I would say is gold and silver outperforming by a pretty wide margin this year. But if we look at things like crude oil, which is the most important, and gasoline and heating oil for people, that's still kind of contained here. So if we're looking at a read into CPI, let's say for May, these factors shouldn't be a big factor pushing up that price index. So interesting to see gasoline for a little while it was starting to surge higher, but has pulled back. And if we look at the agricultural commodities, things like corn, soybeans, still down on a year-over-year basis. And finally, if we look at natural gas, that's a big component for people in their households in terms of utilities. That's starting to perk up again. So kind of a mixed bag, but nothing really alarming here in terms of saying we're going to see a spike in that CPI inflation, because the big driver usually is this crude oil, gasoline prices, and that for now is contained. So if we look at gas prices, we're about where we were last year, so not going to see a huge push from there. I have no idea where gas prices are going in the next year. That's anyone's guess. But as long as they stay here or below this blue line here, it's going to be helpful for CPI. If we see gas prices go up to $4 a gallon or higher, that's going to be hurtful. So something to watch there, clearly heading into the summer. So gold versus broad commodities. Gold has been big story this year, hitting record high. And this is gold versus the broad commodity index. You can see trending higher of late. You can see that it peaked actually in 2020 when crude oil was going negative. Gold was actually doing very well. It tends to do well during panics, and definitely that was a panic in 2020. But following that, you had outperformance in broad commodities driven by that rise in crude oil. But pretty much over the last year, gold has taken that leadership again. Crude oil has come down, and we've seen gold surge and demand for gold heading higher over the past year. So if we look at the last 10 years, what's been the story? Stocks versus commodities. You can see here S&P 500 more than tripling, up 230%. Gold doing better than broad commodities, up 82%, but big gap between gold and the S&P 500. And we actually have commodities index here, the DBC, actually down over the last decade. So very strong decade for stocks, okay decade for gold. Broad commodities, very poor performance over the last decade, but definitely a comeback from where we were in 2020. So it's all about where you measure it from. But the last decade definitely has belonged to stocks and not commodities. Let's talk about currencies here. A lot of talk about the dollar. Dollar's going to crash. Dollar's going to have problems. Talking about national debt, deficits, inflation. A lot of people worried about that. Has not translated yet in the dollar moving lower, at least not relative to other currencies. And that's how you measure the dollar. If you look at things like the dollar index ETF, still very strong here, hitting new highs. If you look at the last 10 years, has trended up overall. There's been periods where the dollar's been weak, but still strong overall, still hitting new highs on a year-to-date basis. What's a big component in this dollar index ETF? Two biggest areas are going to be the euro and the yen. If you look at the euro here, last 10 years, you've seen euro depreciation. Obviously, volatile, moves up, moves down. This year, euro kind of flat with the US dollar. But definitely the trend over the last decade has been stronger dollar, weaker euro. The yen way more pronounced in terms of the weakness, and you can see that here. Just continued depreciation. We haven't seen a yen this weak in decades, and what we're seeing here is really it's driven by a number of factors. But the central bank, the Bank of Japan, just refuses kind of to relent in terms of letting the market dictate interest rate pricing. So they're still manipulating interest rates, even though they finally removed negative interest rates. They were the last central bank to do that. Still, interest rates, I would say, much lower than where the free market would have them set. And as a result, we're seeing a decline in the yen versus the dollar. And if we look at EM currencies here, this tracks somewhat with the performance of emerging market stocks, but it's one factor, let's say, but definitely not the only factor. And this is looking at EM currencies versus the dollar here, and you can see kind of flat year to date over the last decade. EM currencies are lower. These are currencies that are yielding more, so that's incorporated into it as well. But if we're going to see a period of strong outperformance from emerging market stocks, we would expect EM currencies to move higher. So we'll watch this to see if this kind of sideways trend over the last 5 years is going to move higher or lower. Crypto's been the biggest story so far this year, other than Nvidia in markets. And the reason for that is that we have Bitcoin hitting a new high again, and driven in large part, I would say, by the approval of the spot Bitcoin ETF. And we just recently got approval also of the Ethereum ETF. And these two crypto coins are the two biggest, or 70% of the market. You got Bitcoin, I think, around 53%, and Ethereum around 17%. And the rest of the coins from there make up the other 30%. So these are the biggest two by far. You can see here, Bitcoin, pretty sizable correction there, moving from around 68,000 to below 20,000, and then recovering very quickly, especially running into that approval for the ETF. And we got that approval, and you can see here that spike higher went from 40,000 to 70,000 pretty much in a few weeks. And Ethereum, similar situation, has not hit a new high, surpassing its 2021 high just yet, but just a huge advance, more than tripling from its low in 2022. And looking at Bitcoin milestones here, hit that 68,000 mark in November 2021. Then we had that deep bear market, down over 70%. And just this March hits that new all-time high at 69,000 and pushed up as high as 73,000. If we look at Bitcoin, it's a story of volatility, right? This is not something that moves like the stock market in terms of volatility. It's way more volatile, even though it's become less volatile in recent years than when it started. Still multiples in terms of volatility versus the S&P, at least 5x the volatility of Bitcoin versus the S&P. And we're looking here at returns, yearly returns since 2010. See, it started out at almost nothing, so the percentage gain is obviously going to be enormous for that year. But what we've seen from Bitcoin is very rarely does it have a calm year. It's either up a lot or down a lot. We could see 2014 down 58%, 2018 73%, 2022 65%. So not for the faint of heart. You're going to see huge volatility, huge drawdowns along the way, but Bitcoin this year has been king, up 67% so far this year, and again hitting record highs. So the demand for crypto goes hand in hand with the price of crypto. So as the price of crypto is rising, there's more demand from investors. When it's crashing, it was low, ended 2022 at 16,000. Everyone's saying Bitcoin's done, and of course then it recovers, and now there's a lot of interest with prices much higher. So no different than the stock market, where investors get more excited when the price is higher, but I would say much more emotional and psychological driven, just because of the swings in this asset class. And what's driving Bitcoin higher this year, similar to what's driving gold higher: fears about the inflation picture in the US, fears about the debt and the deficit and money supply. All of those things kind of become the narrative when you talk about Bitcoin. And the story with Bitcoin is always the supply is constrained. And so unlike fiat currencies, where you can just print more like we did in 2020, 2021, massive amounts increase the money supply by over 40% in 2 years, Bitcoin, built into the code, is a limitation on how many Bitcoins will be available. Unless they change that, that has been the best story for Bitcoin, let's say, in terms of diversifying out of fiat currency. Okay, let's talk about intermarket analysis here. And this is comparing stocks to bonds, stocks to commodities, looking at relationships within and across markets. And the stock market versus the bond market here, S&P 500 versus the AGG, which is the aggregate bond ETF. You can see here the trend up and to the right. And with the exception of, let's say 2020, where we had that crash, of course, flight to safety into bonds, we have a pretty much strong trend higher. Even in 2022, when stocks were in a bear market, bonds were declining a lot as well. So not typical when you see the stock market go down over 20% like it did in that 2022 bear market. Typically, you see this relationship really come in. It did not do that. The reason for that is stocks were declining because of high inflation, and with high inflation comes high interest rates, and high interest rates are bad for the bond market. And since then, we've seen a big divergence where stocks seem to could care less that the Fed funds rate is up over 5%, that interest rates are higher, and you're seeing this relationship hit new highs again this year. And if we look at the correlation between stocks and bonds, well, kind of interesting that the past 3 years we've seen the highest correlation on record, which means they're moving together more over the past 3 years than they have at any point in history. What's driving that coordinated movement? Well, it's that fear over inflation. So once that fear subsides, once that fear goes down, I expect to have more kind of normal relationship where overall, if you average it out, correlation's close to zero between stocks and bonds. But for now, this kind of seems to persist even this year, where we're seeing when interest rates really spike higher, stocks don't like that. When interest rates fall, stocks like that. And the difference is the returns when stocks have been higher have been much greater than for bonds. And that's leading to a big dispersion in terms of what the actual performance is. So even though correlation's at a record high over the last 3 years, it doesn't mean that both asset classes have done the same. Correlation is not the same as performance. We have the S&P 500 up 32% over the past 3 years total return, and the bond market is down 8%. So big divide. Again, stocks kind of shrugging off higher interest rates, while of course bonds can't shrug off higher interest rates because that is what dictates bond prices in the short run. So stocks versus commodities here, you can see was a huge trend higher heading into 2020. And then we had, of course, crude oil going negative. We hit the peak in this relationship at a reversal then, where commodities outperformed when crude oil recovered, other commodities recovered. That hit a peak when inflation hit a peak in 2022, when crude oil got back close to its 2008 peak and gas prices hit record highs. And since then, it's been all about the stock market again, stocks outperforming by a wide margin since then. So if we look at stocks versus gold, a little bit of a different story, because remember, gold doesn't behave, let's say, like crude oil, very different animal. Some people would consider it a currency, some people commodity. To different people, it's different things. But if we look at the relationship here between stocks and gold, stocks, again, outperforming overall in the last decade, but over the past few years, kind of been sideways, where the relationship peaked for stocks in early 2022. Then we had that bear market, gold outperformed. And then let's say over the last 2 years, stocks have outperformed. But this year, gold actually, with hitting new highs, is actually outperforming the stock market. And if we look at Bitcoin versus the S&P 500, or Bitcoin really versus anything, the chart really just looks like, almost like, I would say, Bitcoin itself, because Bitcoin is so much more volatile than anything you're comparing it to. When Bitcoin spikes higher in price, you're going to see this relationship spike higher. So it's just driven in large part by the movements in Bitcoin. You can see during 2020, 2021, when Bitcoin was going crazy, going from a few thousand in early 2020 to its peak, and since then it's had that correction, right? So it went from 20,000 to almost 70,000, had that correction, and underperforms. It's going down way more than the stock market during that 2022 bear market, and then it's going up way more on the way up. So this is a relationship really telling you not very much, other than the fact that Bitcoin is extremely volatile and it will continue to be. And the relationship isn't hitting new highs here, which is kind of interesting. If you look at the S&P versus Bitcoin over the past few years, you're still not seeing new highs in terms of Bitcoin relative to the market. And this is a snapshot I like to look at that shows you all the different asset classes, the major asset classes since 2011. And what we're seeing this year is pretty similar to last year in a lot of ways, where we're seeing Bitcoin lead everything, growth outperform, and we're seeing U.S. large caps, as we talked about, outperform small caps and outperform international stocks and emerging market stocks. But the difference between this year and last year would be that bond area and REITs, which have been hit so far this year by higher interest rates. And so what we saw last year at the end of the year is we had that sharp move lower in interest rates, which really saved the year for bonds. So the year's not over, a lot to go in terms of the year, but so far that higher move in interest rates, the 10 years gone from about 390 to 440, has really hurt the bond market. You can see not huge, only down, looks like here 0.5%, but longer duration getting hit harder. And obviously REITs being sensitive, getting hit as well. So overall, pretty good year for asset allocation, led once again by U.S. large caps and U.S. growth stocks, value underperforming. And if we look at small caps here, down up less than 1%. So big spread between large caps up almost 12% and small caps up less than 1%. Okay, so I want to end with the US economy and just look at a snapshot where we are, perhaps where we're going, what are some concerns. And we have to look at first GDP. Great news, the expansion hit 4 years in the first quarter with the GDP being positive once again. We have cumulative GDP growth over this period of time, 20% annualized, that's 4.6%. And if we look at the most recent trends, what we're seeing is a slowdown here. So we had 4.9%, third quarter of last year, fourth quarter of last year, 3.4%, and the first quarter of this year, 1.3%. So definitely seems to be trending lower. And what are the expectations for the second quarter? Well, we're seeing the Atlanta Fed's estimate, which changes based on real-time data, below 2% now. Wall Street seems to be saying a little bit above 2%. But definitely the expectation doesn't seem to be we're going to see those 3, 4, 5% growth numbers that some people were talking about. Doesn't seem to be happening or likely this year. So if we're seeing persistent inflation, if you're feeling persistent inflation, you're not alone. The fact that is that now we're at 37 consecutive months above 3%, which is the longest run of higher inflation we've seen since the late 80s, early 90s. So it's been a long period, over 3 years of elevated inflation, and the cumulative effect of that continues to grow. So each month that we're above 3% or above 2%, we're increasing that gap, with the 2% inflation trend line, that blue line here. That red line just keeps going higher at a faster rate. So the Fed wants to get back to 2%. That's a great goal to have, but that's not going to close this gap in terms of the spread between where we actually are and where that 2% trend line is. And I think the cumulative effect of this inflation is starting to really hamper a little bit consumer spending here. And so we're seeing retail sales kind of in a difficult pattern here where we're below the historical average over the past 2 years, kind of persistently on a monthly basis. So if we look at nominal retail sales, up 2.67% over the past year, 4.65% has been the historical average. We look at real inflation adjusted retail sales, down almost 0.7% versus usually we're up 2% above the rate of inflation. So that boom that we saw in retail sales, and it was an absolute boom in 2021 from the COVID stimulus. Well, now we've kind of normalized here, and I think that cumulative effect of inflation definitely, clearly seems to be impacting the U.S. consumer. The unemployment rate slowly rising here. So 3.4% in April 2023. We're at 3.9% now, but that's still very low. So unemployment ticking up. You definitely don't want to see it continue to go up, but still very, very low on a historical basis. How low? Well, we've been below 4% for 27 straight months. That's the longest period below it since the late 1960s. And if we get another month, it'll be the below 4%. It'll be the longest since the 1950s. So you have to go back a long time to find unemployment this low for this long. And a big reason for that is simply the labor market was unusually tight over this period of time. There was the demand for labor much higher than the supply. So during COVID, a number of people left the labor force. A lot of people retired early. It was very difficult to incentivize those people to come back, especially now with stock market gains we've seen over the past few years, home prices going up. Household wealth is much higher in the past than it's been in the past. And as a result, more people are retiring early, and you have that labor shortage also driven by stimulus and the unemployment programs. But lately, the trend has been reversing very slowly, loosening, but every single month we seem to be a little bit closer to a normal labor market. If we're looking at job openings here, we hit a peak of 12 million job openings, and now we're down to 8 million. That's the fewest since February 2021. So fewer people quitting their jobs, fewer job openings available. This is a sign that the labor market seems to be healing, getting close to a normal balance between supply and demand. I'm going to end with one more chart to watch. This is my favorite chart on the economy, the most important chart for people to pay attention to, which is the relationship between wages and inflation. And as long as this is positive, this is a good sign for the economy. When workers are earning more, then prices are going up. That leads to an increase in prosperity. The good news is that this has been higher now for 12 consecutive months. But you can see here, the gap is kind of narrowing, and that's because inflation has been persistently high. And instead of continuing to move below 3%, it's kind of struggling here. We want to see inflation come down. We want to see wages outpace inflation going forward. It's a very difficult period, 25 consecutive months where we had the opposite, where inflation was outpacing wages. So most important chart to watch always in terms of the economy is seeing how workers' compensation compares to inflation. That's going to be reflected in a number of different economic statistics over time. And every country that has had an increase in prosperity has seen this be in the positive end, and the positive end for a long period of time. Okay, with that, I'll end the charting section, and I want to talk briefly about this free wealth path analysis that we're offering at Creative Planning. You could go to creativeplanning.com/Charlie to sign up for a meeting, sign up for a call, and we're going to do this free wealth path analysis for you. What does that entail? Well, we're going to take a look at pretty much everything that's going on, a high level view, what's going on in your portfolio. So portfolio checkup, looking at the vehicles that you're invested in. Are you diversified? See if you can take advantage of tax loss harvesting. We're going to look at retirement planning, hopefully tell you you're in good shape. Anything changes you have to make to kind of meet those retirement goals. Taxes, big for us at Creative Planning. We have a huge team of CPAs that will help look at everything in your purview and say, this is what you should be doing in terms of taxes. This is where you should be holding certain assets. So we don't believe in holding the same portfolio in, let's say, your IRA and your taxable account. There's ways to position to benefit you in terms of taxes. And we'll look at estate planning, which is very, very important for a lot of people, making sure all the legal stuff is in order. And we have a lot of estate planning attorneys at Creative Planning that could help you with that. So overview of Creative Planning. We're in all 50 states. So wherever you are, we are likely have a location near you. We are over 300 billion in assets under management and advisement, and we're here to help. So go to creativeplanning.com/Charlie to get more information. Sign up for that free wealth path analysis to get some actionable things to do in your portfolio and your plan. And I hope you take advantage of that. And I'll see you next time on the regular edition of the Week in Charts. If you're watching this on YouTube, hit that subscribe button for more content just like it. Thanks everyone for watching.